Oh, you did?
Yeah, I survived 6 years.
Well,
These winters, I say.
those winters. And, I was a runner and I was a crazy runner. And I used to run in the winter. And I had an even crazier running partner. And her whole thing was, if it was 10 degrees or higher, we'd run and we'd run around the lakes. Yeah, no, that's not a good thing.
Yeah. Oh.
What part of Minnesota did you live in?
1 year in St. Louis Park area, and then 5 in Eden Prairie.
All right. My
Yeah.
oldest son lives in Eden Prairie.
Okay.
And I used to run, I used to live right over by Lake of the Isles. So I used to run Lake of
Okay.
the Isles, Lake Calhoun,
Yeah.
and sometimes Lake Harriet. Yeah,
Oh yeah. Great
all at
areas.
one time.
And where do you live now?
Now I live in Studio City, California.
Okay. So I might be following you because I'm in North Orange County. So
You
just gonna
are.
follow you around, Patricia. Yeah.
You can
That's
do
funny.
that. Are you tech savvy? Because I could really use somebody that's tech savvy following me around.
Some days I'd like to think so. Most days, probably not.
Well, good. I've been out
Yeah.
here for a long time, and I have 4 boys, and the oldest one, he wasn't going to move because his girlfriend was living in Minnesota, who he ended up marrying and having children with.
Oh yeah.
But 3 of them, I just sort of, the last one, I'm like, you want to go to school out in LA. And then when he moved out, I went, I'm out of here. Yeah.
Oh.
So
Yeah. I was telling Shane earlier, I can't complain. He's in Michigan, can't complain about SoCal here. So
no.
everything's good except for the taxes and traffic.
Oh my God, the traffic. But you know what? I was back in Minnesota. I'm an interior designer. That's my trade. And I was doing a house back there, a kitchen and a bath. And the time that traffic from going from Richfield, I know you know where that is,
Mhm.
to way over to Vadnais Heights, which was where I was staying.
Yeah.
I'm thinking, what am I'm back in LA. It
Yeah.
was terrible. It was just
Yeah.
terrible.
Yeah. It's getting busy everywhere. In the main cities anyways.
Well, and then I was in Palm Desert, which Cindy will know it's the same temperature as Phoenix, because I used to live in Phoenix to Scottsdale. But
oh my gosh, I lived in Phoenix too, Patricia. We're like the same person.
That's funny.
and at that time I used to roller skate, because that was when my kids were really young. And I used to roller skate around Chaparral Lake with my it looked like little ducklings following me. But so I was in the desert, and Monday they had a windstorm with 80-mile-an-hour gusts.
Oh wow.
So needless to say, I was supposed to come home on Monday. Well, that wasn't going to happen. And then Tuesday was my birthday. I was supposed to come home and have dinner with one of my sons. Yeah, no, I stayed in the desert with my 2 dogs because I was so afraid that drive down the 10 was going to be horribly windy.
Yeah. Oh boy.
Never good.
Don't tell me where you're moving to next, because I think I'll follow. Only because I call Arizona home. That's where I spent most of my growing up years. But yeah, I'll talk about that in a little bit.
Yes. Okay. We'll talk later.
Yeah.
Okay. You should on the chat. I'll leave my my info, and you can.
Yeah, absolutely.
Please do.
Can talk. Yeah.
I always encourage everybody to network on the chat side over here.
Yeah.
Yeah. We'll catch up.
Absolutely.
Okay.
All right, Jenny, I think people are starting to trickle in.
Okay.
We realized we had a problem with some of our links are still on previous daylight savings time. So I think we had it all figured out. And so, but we might still get some people that trickle in, but.
Absolutely. You want me to start?
Please.
Okay, great. Let me share my screen here. Okay. Can you guys see that?
It looks wonderful.
Wonderful. Okay. Well, good. Well, first off, just showing some gratitude. I thank you, Shane and City, for inviting me on. I'm grateful for you guys taking time out of your busy day, I'm sure, to listen to my journey. And my goal is to make this super conversational. Please stop me at any time if you have any questions. And really to just educate, share what I know, and hopefully to inspire any of you guys to jump into this as well if you haven't done so already. And yeah, give back. And that's my way of giving back. Just sharing what I know. So I'm here. Oh, go ahead.
So Jenny, in our group, we have a wide range of people in the investor network, right? Someone just trying to figure out their way, trying to figure out what to do. And we have people that are very experienced.
Perfect.
But I don't think we have too many people that have a story like yours. And
okay.
Cindy said that she talked to you about coming on. I was very excited. So
good.
What you have to say and hear how you did it, how you do such an amazing job, what you do.
Yeah, awesome. Good. So I'll try to explain all the terminology. If I go too fast or you want me to re-explain something, please just stop me. And I'm happy to go into more detail just to make sure I cover everyone's bases here. So I'll start. So quick introduction of myself. So again, Jenny Gou, I'm currently a full-time real estate investor. In my previous life, long story short, I'm actually the daughter of immigrants. I was born in a refugee camp in the Philippines. My family's from Vietnam, but everyone's heard the American dream story. We truly lived it ourselves. Went to Canada for a couple of years and then migrated over to the US when I was about 9 years old. I call Arizona home. I went to school in the Mesa Gilbert area and then got my undergraduate degree at U of A down in Tucson. And then from college, I started working at a company called Procter & Gamble. So for 13 years, I was a sales director there. I lived in the Midwest for 11 years, Minneapolis for 6, and Cincinnati for 5. But while we were in Cincinnati, my husband and I both worked for Procter & Gamble. And we started to look elsewhere to diversify our retirements. All of our savings, all of our retirement funds was in one company. And we just wanted to spread that out a little bit so we weren't reliant on one source when we retired. So we started investing in single family homes. And I'll share that story in a second. And then fast forward to 2023, we have a company called Vertical Street Ventures. And I'll talk about that in a second too. But here's my family. I have 2 young kids, a 9-year-old son named Jackson and a 7-year-old girl named Zoe. We live in Southern California, sunny Southern California. And yeah, that's kind of my background. Okay. So in terms of Vertical Street Ventures, we started this company. I found a mentor back a couple years ago, and he became eventually a partner. We started this company a little over 2 years ago, but now we full-time invest. I left my job in the beginning of 2020 at the age of 34. I'll let you do the math. And then all of that to say is that if you find something that you're passionate about and that you love doing, you can find a way to leave the rat race if you find the right mentors, the right coaches, the right people, and the right team to help you along the way. So with my mentor, who's now my partner, we started a company and added in some more partners, but collectively we now have about $300 million of assets, all in apartments. So multifamily is another word for it, syndications, all but one property is in Arizona. So we focus predominantly in Phoenix and Tucson, and we have one property in Arlington, Texas. So this is just a glimpse of our Phoenix portfolio. We have a wide range of unit size, as small as 22 units or doors, all the way up to 252 units. And this is our Tucson portfolio here. We have currently 5 properties down in Tucson. And then full cycle deals. So these are properties that we've either sold already or we've done a cash out refinance. Okay, that's what we consider full cycle. The ones that we've sold are these ones here on top. And all 3 properties we've been able to sell in less than 2 years of a hold time. We typically anticipate 5 years of a hold time. However, when we execute the business early, or the market has the right conditions, we'll sell if we hit our target numbers early. So these properties we've all sold in 2 years or less. And the last one we sold was this one here, Midtown on Seneca. This one achieved a 3x return for our investor money, which is, I don't know if anybody likes 3x, but I do.
I do.
Yeah, exactly. And so that was wonderful news for our investors. We sold that last year. These 2 on the bottom is what we did, what we call a cash out refinance. We were able to increase the value of the property based on how we operated it and how much renovation we put in. And so for both of these, we've done 100% cash out refinance for investors and still kept them in the property. So now they have their capital back, but they're still getting cash flow from the income coming into the property. So that is a great way to plan B option 2 if you're not selling, to keep it if it's cash flowing, if it's a good location, if it's a good asset as well. Okay, so 2 different types of exit plans or strategies for our business model. Okay, so let me talk about leaving your W-2. I assume everyone here is still working the W-2 job, either because you need to or you love it. Either way is a typical scenario. But let me tell you about how I left my corporate career and why now I'm a full-time real estate investor and I'm helping others do the same. So I always love quotes. This one, a college friend of mine always said this to me because his dad did to him, but if you fail to plan, you're planning to fail. And I say that because if you would like to leave your W-2 job, you can't just wake up one morning and throw in your 2-week notice. Unfortunately, it doesn't work that way. You have to plan accordingly. And I'll show you kind of how we thought through the process of us leaving. So how was I able to leave my W-2 job? So I mentioned earlier, when we lived in Cincinnati, we started investing in single family homes. Okay, we met the right person. We met a friend who was a broker who was also a property manager herself. She said, why don't you guys start diversifying into real estate? Right now, homes, when we started buying homes in Cincinnati, our most affordable home was about 80 grand. We all the way up to maybe 140 grand, but we were able to get rents upwards of $1,000. Now they're up to like 1,300, if not more. So if you do the 1% rule, if you're not familiar, is you try to find a property where the purchase price is, let's say, is $100,000. You want to get at least 1% of that in monthly rent. So each month you should try to aim to get $1,000 of rent. Okay. So these properties,
that's hard to do in Phoenix.
It's definitely hard to do in Phoenix as it's gotten more expensive. You'll find that for higher cash flow properties in the Midwest and Sunbelt Southeast states typically fit that 1%. It's gotten a lot harder to hit the 1%. I'll just put it that way. But that's our benchmark, and that's what we typically we're looking at. So we found one. It was not as hard as we thought it was going to be going into our first rental property. So then we bought 9 more. So we accumulated about 10 single family rentals, long-term, so 12-month leases, so not the short-term kind. And we said, you know what? There's something to this model. I wonder how we could scale faster, bigger, faster. Okay, so for these 10 homes, we were getting on average a month $12,000 of monthly gross income. Okay, so
And
that's
Jenny, what kind of time frame is that you acquired 10 houses?
within 2.5 years.
2.5 years to get 10.
Yes. Yep. And this is, we got traditional loans with the bank, financed everything. Each home we put maybe a couple grand just to fix it up a little bit. So we try to make it as turnkey as possible to get that payout and that ROI. So, once we got to 10, we were like, oh man, there's something to this. How do we get this bigger, faster? And then we started meeting more people. We went to meetups, and that's when we learned about multifamily. So if you think about 10 single family homes, while it looks great and sounds great on paper, we were also dealing with 10 roofs, 10 insurance companies, 10 different loans, 10 of everything. And with a full-time job too, it was a lot to manage. And so when we were introduced to multifamily, we just absolutely fell in love with the model. And so the next question you might ask is, well, what's the difference between a single family and apartments and multifamily? And I'll tell you, when my husband, it was his idea actually, so I credit him. He came home one day and he said, you know what? We should go buy an apartment. And I about fell out of my chair because, well, what do you mean go buy an apartment? Like, we can barely handle 10 single family doors, let alone an apartment. And we can't even afford an apartment. Like, I just thought he was crazy. And so the more we learned about it and the more we talked about it, it just made sense. So here's why. So comparatively, a single family home versus a multifamily, you can get so many more doors under one roof versus individual doors. So under one roof, we can get, 20 units, 50 units, even 100 units in one building. So it's a lot less of a work to manage. One loan, one insurance policy, one of everything versus 10. Scalability of resources. So this is just basic economics. The more you have of something, the cheaper per unit or per door it'll cost you. Things like maintenance, even insurance and taxes and monthly expenses, utilities, so on and so forth. So the scalability of resources is a lot more beneficial the bigger you go. That's just straight economics. This is a cool one. So value is dependent on different things. So when you guys think of single families, what is the value of your home based on? Anyone can answer this question. What is the value of your home based on?
See if anybody writes in the chat. Typically, for a single family home, we're looking at an appraised value or an appraisal.
Yep, and that's basically what is the comp next door, right? So when you talk to realtors, exactly, it's the comp next door who's got a similar 3-bedroom, 2-bath down the street and how much did they sell for, right? So your value of your property is based on your neighbor. You have no control over it whatsoever. Whereas the value of a multifamily property is based on your operations. So it's run like a business. How much net income comes in after you generate all the rent that comes in and you pay all of your bills, utilities, expenses, maintenance. Your net income and a factor of the market cap rate determines what the value of your property is. So the better that you manage your property or your business, essentially it's just running your profit and loss in a business, the better the value increases. Okay, does that make sense? Okay, so we love that because coming from our corporate background, we ran businesses all day long. So we said, hey, it's something that we can control and not dependent on somebody else. And this one's really neat too. So less financial risk with vacancy. So what do I mean by this? In our single family homes, what happens when a tenant moves out, a resident moves out? Who pays 100% of that rent or mortgage still? We do, right? So that's 100% cost still dependent on us. Whereas in a multifamily door, again, the larger you go, the more scalability. Most of our properties can be 50% vacant and we could still break even, right? Because of the size of it. And that's really important, especially in an economic downturn, or if there's something else wrong with the economy, or there's a massive layoff at a company next door to the property. We are less at risk because of the size and scale of the building. Okay.
Jenny, is there then maybe you're going to get to it, so just tell me to zip it, but is there a certain size or number of units per apartment building to make that work?
Yeah, it just depends on the number of doors that you have, and of course the loan that you have on the property. So there's different factors that can play out to get to that break-even economic or economic vacancy number. But typically, you probably want to look at anything 50% or plus to be on the safe side. Okay. So those are the differences, the big differences between single family and multifamily. Okay. Any questions on that so far?
And one of the advantages of multifamily is also on-site management. You know, that one person moves out of the single family home, not only is that nobody paying any of the mortgage, but somebody's got to go in, clean it up, get it rented, interview new tenants. Where you have a multifamily, you might have somebody on staff that does that. Is that correct?
Yeah, so you can actually find property managers to manage single family homes as well. They cost more per door. With multifamily, yes, you can definitely have somebody on site within the office managing the day-to-day operations. And the cost of the on-site manager, the property manager, again, goes down per unit, the bigger the property that you have. Absolutely. Yep. All right. Okay, I'll keep going here. So what exactly is a multifamily model? So we could take you back to my story real quick. So when we learned about multifamily, at the same time, we also decided to move back to California. This was over almost 4 years ago. And we loved this model so much that I actually left my job at P&G before even purchasing a single multifamily door, which is actually very backwards if you think about it. You should probably plan this out and test it first before you just throw your towel in. But that's how much we believed in this model. And because we were generating enough cash flow from the single family homes to offset some of my salary, we said, Ronnie, you'll stay at P&G for the stability, and then I will go 100% in full time to this multifamily model so that we could scale up faster. Okay, that was our plan. And so then that's how we've been able to scale so quickly in the last 2 years. But what exactly is a multifamily syndication? Because I don't have millions of dollars in my pocket to go buy a building by myself. So what we do is it's called a syndication. Okay. And here's how it works. So our team, and there's lots of teams like us out there, but what we do is we go out, we work with brokers, and we'll go find an apartment building. It's called acquisitions. We'll work with brokers in the marketplace. And when we find the deal, we do the underwriting, the numbers look good, we sign the contract, and we take it down. Now, we buy properties that might need a down payment. So we'll still finance it just like a traditional home, but there's those few $1 million that we need as a down payment to cover the loan, to cover the down payment, to cover funds for renovations, and then closing costs, reserves, all of that, okay? We go out and we raise capital from investors. Those investors who want some passive income, and I'll go through an example so you guys can see the numbers, but don't want to do the work. So we do all the work, and then we pay out our investors every quarter, coming from the cash flow that we generate from the property. Okay.
Now, before you bought your first multifamily, were you already familiar with raising capital for your single families, or is that completely new to you as well?
That was new to me. So when I left P&G, COVID just started. Everything shut down. So my typical day I thought I was going to have ended up being homeschooling 2 kids while doing all this learning in real estate on the multifamily side. But I found a mentor, and I lashed onto him and I said, I will intern for free for you. Just, teach me what you know. And that's how I learned super quickly. It took me about 9 months before we actually bought our first multifamily property. Okay. So it does take a little bit of time, but having someone help teach me accelerated that learning. So, so we raised capital on the deal when we signed the contract. Once we close on it, that's when we start executing the business plan. Okay. And then after, call it 5 years or earlier, we'll sell the property for a profit. So this is what we typically do. We find class B or C, and what that means is older properties. And just to simplify, when you think about flipping a house, you hear people buying it, remodeling, and then flipping it for a profit. That's a general high-level way of looking at what we do for apartments, just many, many, many doors. Okay, but we add value and we make the properties cleaner, safer, all of that stuff so that our residents have a nicer place to live. But we find these older properties, they're in good neighborhoods, and we renovate them. We do some exterior renovations, maybe we repaint it, we clean up the curb appeal, we add a new sign, and we renovate the inside as well. So here's an example of one of the renovations.
Nice.
Right, so here's an inside of a unit. You can tell it's definitely built in the 70s or 80s. We go in, we put in a nice appliance package, we rip out the cabinets, maybe we'll redo the flooring, lighting, fixtures, etc. I can tell you for this property specifically, the average rents were about $500 a month. And after renovations, they went up to $1,000. Okay, so we are able to do that because the comps of rent in the area were charging around $1,000. Okay.
Now, Jenny, was your plan to go in and a lot of renovation, or did you renovate as cash flow allowed, so to speak? Did you raise the fund for renovation?
Yeah, we raise those funds as part of the initial process of capital raising. So we always come out with, here's our business plan. We need X million for the down payment and then X million for the renovations. And here's what we're going to do with that money. So our business plan was to go in to renovate, and we only renovate when people move out, right? So it's a several month, if not year process to turn units as people move out or they choose not to renew and they find somewhere else to live. They don't, like the property anymore. So we're able to, again, going back to the operations side, we're able to drive the income because of the renovations, and that drives up the value of the property and it drives up the cash flow. So we find apartments where essentially it needs a little bit of TLC, sometimes a lot of TLC. We'll renovate it inside and outside, able to charge market rent because we added all this value to the property. And then typically, we look for properties that at least have an 80% return or a 1.8 ROI on our investors' money. Okay.
So Jenny, give us an idea then per unit. Now, obviously, the square footage, bedroom count, and all that plays an effect. But what are you looking for a renovation budget?
Typically, so this renovation for us costs about $15,000 to $20,000 a unit. Right. Okay, it was I would say we actually probably over-engineered the renovation based on that market and that area neighborhood. But in general, these days, this was a couple years ago, these days, it's closer to $20,000 with inflation and labor costs to get something like this to look like this.
But even then, at $500 a month, $6,000 a year, 2-3 year payback on that renovation. Yes. Yeah,
and depending on how long you hold it, you don't necessarily look at it as ROI on the time frame, but you look at how much income and value you now have because your income per month has gone up.
Got it.
Okay.
The overall value of the asset's gone up for you to either cash out, refi, or sell it.
You got it. Yeah, and we'll do conversions too. Sometimes if there's an office that we don't need, we'll convert that into a 1-bedroom or 2-bedroom, and that's instantly, another $200,000. You're spending $20,000 on the renovation. You just increase the value of the property by another unit, which is, call it $200,000 for an extra door. Yeah, so there's lots of different ways we can drive the value. Okay, so let's go through an example. Okay, so let's say you invest $100,000 into the property as an investor, a passive investor. Okay, just for round numbers. And I tell you, in 5 years, which is typically the whole time we analyze our properties for, I will give you 100% return, essentially meaning double your money, okay, in 5 years. And on average, part of that return is on average, we'll give you 8% cash flow every single year for those 5 years. So here's the math. Okay, so year one, 8% is $8,000 a year, all the way through year 5. Okay. At the end of year 5, we executed the business plan, we're able to sell it, and the proceeds from that sale, your portion of that is $160,000. Okay, plus the $8,000 of cash flow. So I'm returning 100 grand back to you. That's your initial capital. And there's $100,000 of profit inclusive of your cash flow each year. Okay, so that's how I get the double your money, 100% return.
Have you ever had anybody that wanted or needed to be out before their 5 years was up?
In terms of an investor?
Yes, ma'am.
Yeah, so that's the difference between investing in real estate and investing in the stock market. Stock market, you can buy, sell at your will any minute of the day. When you invest in something like a real estate asset in a syndication, you have to assume your money is illiquid for that time frame. Okay, because all that money is going into the renovations, all of that has gone down to the down payment. We do have options. We haven't, I think in my time so far, we've had one investor in dire need of cashing out. And the way that they can get out is if they sell their shares to another investor. Okay, so that's one way, but it's complex. It takes time. If it's your last, I always tell our investors, if it's your last 50 to 100 grand, and that's your savings, you should not be investing in real estate. Okay, you can't depend on that. Great question.
Yeah, these are scenarios that we talk about when we talk about buying real estate or funding a deal using a 401k, for example. It's a long-term money.
Yes.
In there, let it gain some interest yearly, and at the end of your cash out, you have a nice big bonus.
Yes, exactly. That's a lot of our investors invest with a self-directed retirement fund. Absolutely. Yep. All right. Okay. Where am I? Whoop. Okay. So if you're looking to leave your corporate job or whatever profession you're in today, you want to plan. And this goes back to the quote, if you fail to plan, you're planning to fail. What we did was, we did some math. So before I left P&G, we sat down and we did some financial planning. We said, okay, what are our average monthly expenses? And then how much income do we need to offset what I was currently making and feel like we were in a good place? So let's assume a family of 4. So just not real numbers, but close. What should your passive income be based on these numbers? So I just took some ballpark math, right? If you're paying, a mortgage of rent of $2,500, your utilities, phone bill, car payments, insurance, groceries, gas, shopping, entertainment, kid stuff, emergency. Let's say you average about 9 grand a month for a family of 4. Okay, that seems reasonable depending on where you live. What do you want your passive income coming in to be? Because you want to make sure your income is greater than your expenses. That's basic math for being financially independent. So anybody, what would you like your income to be? Probably at least 10,000, right?
Yeah,
to cover your expenses, you want to be definitely more than 10,000 at a minimum, just to cover any additional emergencies that might come up. Okay. So
I like your plan, Jenny. I went through something very similar years ago. My now ex-wife and I exited the corporate world. We were running a company together that she was running, and I wanted to exit my W-2 job, and we kind of went through that same scenario. We created a budget. Said, okay, we're going to cut, but we're not going to cut too deep. Trim off the excess fat, get down to a comfortable budget, and looked at what the business was doing now to supply, and it was pretty close. So okay, what we need to do to get the business to support our minimal livelihood, and then grow it. So we kind of went through that same scenario. I love that idea.
Yep. And it's just, even if you weren't leaving your job, it's still a good exercise to do anyways, to understand what your monthly expenses are and where you can cut. So I think everybody should do this regardless. Okay, so another example. If you wanted a $10,000 a month income from investments and assume that the same $100,000 gets you 8% cash flow a year, then $8,000 a year is $667 a month. Okay, so you would need $1.5 million of in cash to invest, assuming they all give you 8% cash flow to get close to that $10,000 a month, right? So
Mhm.
who's got 1.5 million? I wish, right? To
You
invest
would-
all of that. That's what we're trying to get. So yeah, most people don't have the 1.5 million to invest. And most can't guarantee an 8% annual cash flow. Okay, so what else can we do? Well, there's another way. And this is what kind of gets into what I do full time. So there's two ways you can be investing in these syndications. You can be passive. So you're the person putting your investment in, but you have low participation, less control. You don't need any experience. You don't need time. It's by definition passive. You don't do anything. It's like investing in the stock market. You don't participate in, Microsoft daily activities. You're just a passive investor in their stock, but you own shares. Okay. And you have a lower risk. Where on the flip side, what I do is I'm an active sponsor. I'm the one that's going out to find the deals. I'm the one raising capital. I'm the one that's running the property day to day. So it's a higher participation. I have higher control because frankly, we don't want or need 100 investors telling us what their opinion of the paint color should be. Like we'll decide all that, right? Higher experience level, more time, and definitely higher risk. The risk is the important thing to know about this one is I sign on the loan. I'm on the hook for the asset. Passive investors are not. Okay, you're completely limited and protected. So if something were to go wrong with the property, what have you, then the bank or the lender comes after us, right? We're 100% on the hook. Passive investors are not. Similar with the stock market.
So Jenny, then this is done through, you said syndication. So all this is being done through a LLP or an LLC. Is that
correct? Yes. So every single property has its own LLC that owns the property. And we as investors invest into that LLC. So you actually own the asset directly as a passive investor. It's all SEC regulated. So we go through an SEC attorney to generate all of the legal documents, operating agreements, entities, subscription agreements, everything that you should be reading to make sure you're protected for that investment. Okay, super important.
and if you're going to get into it later, just say so, but was that a difficult process to go through?
To invest?
Process?
I'm sorry, can you repeat the question?
Or an expensive process to get into the SEC portion of?
Oh, yeah. So we go through the attorney, and that all of those costs we roll into the closing costs as well. So all attorneys, everything related to title, surveys, lender requirements, applications, all of that goes into closing costs that we calculate. Yep. Okay.
What kind of time frame does it take for you to identify a property, go through all the syndication, attorney stuff, the appraisals, the due diligence, raise the funds, and then close? What are you looking at? Time frame?
So from the day we sign the contract through closing, typically is 60 to 90 days. Okay. Within those 60 to 90 days is when we start raising capital for the project. Now, to get a good deal, because it's so competitive to get good deals out there, I mean, we've built really strong relationships with brokers to find us the best deals. So that relationship we've built over years. Okay.
Okay.
All right. So this is the difference between being passive and being active.
Are you going to talk about how you find your deals?
Sure. Yeah, I can talk about that. Yeah, I don't have a slide, but yeah, I'm happy to talk about how we find deals. So traditionally, we use brokers like CBRE, Marcus and Millichap, ABI, all the big name brokers. Those are probably where 95% of our deals come from a broker.
Okay.
Because we've built great relationships, the better deals or the best deals are ones where it's not marketed. So where maybe in the single family home world, it's called pocket listings or things that are not on the market yet, because we don't want to go into competition with a ton of other buyers. So we've been able to get a few deals, if not more, where they're not listed, and that way we're not competing on price. But if they are listed and we are competing against other buyers, then our relationship weighs a lot because the broker can, they have the seller's ear and they can say, hey, you know, Jenny at VSV, they're great buyers. They'll close 100%. They've never lost a deal or had to back away because of lack of funding. So we've spent years building those types of relationships to get the best deal.
And that hopes that you're in a very specific market too.
Absolutely. So we focus on one market because we've built such a great team and network of resources. Once you start focusing on more than one or two markets, then you're just spread too thin. Yeah. And you're not an expert. Like, we like to be an expert in the market we focus on. Okay. Good questions. Yeah, so you can choose to be passive or active or both. So I'm both. I still invest in other people's deals because I want the passive income and I want to get a pulse on other markets. But my time these days is focusing on being on the active side. Okay. All right, there's a question from Liza. I think hopefully I'm not mispronouncing your name. It's my understanding that if using self-directed funds, I am not allowed to materially participate in the day-to-day activities of the property. Is that correct? So yes, if you use, and I have to caveat, I am not an attorney, tax advisor. Please consult your legal professional as well. This is just my opinion or what I know. For self-directed funds, you cannot use that to participate in your own deals if you are an active sponsor. It has to be 100% passive. So great question. Yep. Okay, so going back to this, you can be passive or active, or both, it's up to you. It's really dependent on what your goals are. A lot of the folks we work with are passive, and then a lot of folks we know are also active. So it just depends on you.
I guess, Jenny, just to piggyback on that question, the reason behind that is you're not really investing in the asset. Your IRA is investing. So you being an active participant is unrelated to your fund. So,
yeah, and I think it's just a rule that these retirement funds have in general, is that it has to be truly passive. So you're self-directing your funds in another vehicle. It has to be something where you don't control it. So it has to be a passive deal. Yep. Okay. So the next question you might think, well, why would I want to be an active sponsor? What would I get, or what are the benefits of that? So I'm going to walk you through a pretend scenario here where you'll see more of the wealth building and the income generating side of this actually comes from the active side. And that's why, you know, you see folks wanting to be a syndicator in this space. So the active income includes, in many scenarios, these three things: the acquisition fee, which is on average 2% of purchase price. We'll just use that for this example. This is a fee charged upfront and taken out at closing, because as I mentioned earlier, it takes years to build relationships to get the best deals. And then the process of taking down a property is a ton of work for those 60 to 90 days. And so this is the acquisition fee that covers the time, work, resources it takes to take down a property. Okay. Then you also get an asset management fee. So we hire a third-party property management company to manage the day-to-day, and then we manage them. So I don't take the phone calls of broken toilets. You don't want me fixing toilets. It would just stay broken forever. So we have somebody else do that for us. They manage the leasing, the marketing, the day-to-day tasks related to the property. And then we meet with them on a regular basis to make sure they're executing the renovation plans, the day-to-day leasing, collecting rents, managing delinquencies, etc. So you get 2% on average of the gross income every single month. And then when we sell the property, we also get to split the profits, and that ranges between 30% of the profits to 50%. I say there's a range because there's different ways you can structure it, but for right now, just know that that's a normal range. Okay, so here's another example. Let's say you buy a property, the purchase price was $10 million. The gross income every single month is $55,000. And you sell in 5 years at $17 million. Nice bump in appreciation, okay? So upfront right away, acquisition fee at 2% is $200,000. Then over 5 years at a 2% of gross income every month, at a 5-year hold, you're getting another $66,000 of asset management fee. And then when we sell at a 30% split for the sponsors, that's about $750,000 of profit. Okay, there's a lot of back-end math, which I don't want to bore you with an Excel spreadsheet, but just know that that's an example of a property that we typically could look at. Okay, so if you add all of that up, it's over $1 million, right, within a 5-year hold time frame, versus a passive investor, you get 100,000 of profit over 5 years. So massively different being on the GP side versus the LP side or passive side. And let's say you only do 1 deal a year for the next foreseeable future. Like, think about the wealth accumulation as you start to sell, or you cash out refinance when the market's right, and you take that capital back and you rinse and repeat, right, while still holding on to the property. So you can already see the value of the purchases on the sponsor side if you wanted to be active. Okay, very different.
And there's definitely some tax advantages and consequences being a passive versus a active investor. But one of the other things I noticed is that acquisition fee, you paid that upfront at closing. Is that correct?
Correct.
Yeah.
Yep. So you must be reading ahead, because speaking of other benefits, so my husband and I used to joke, he loved to talk tax benefits and it would just taxes and just would put me to sleep. Now I can talk taxes for hours and it's so exciting. And you could never say that before. But other benefits. So again, I'm not a tax advisor by any means, but here's how I understand a lot of these benefits to benefit real estate investors. And why are there so many good benefits? It's because the government doesn't want to manage housing. They want us to buy property and real estate. They want investors in real estate. And that's why taxes are their method to incentivize behavior that they want. Okay. So a couple things you need to know in terms of benefits. There's this thing called real estate professional status. Basically, there's a bunch of rules, and I'll talk through the criteria here. If you qualify as a real estate professional or rep status, you can essentially potentially offset federal income taxes. Okay. And here's the criteria, and I'll give you my example. A couple ways to qualify, and this is like a Scout's Honor type qualification. You just fill out a form and your CPA submits it for you. But basically, you have to perform more than 50% of your time in real estate. So if you work a 40-hour work week, you need to work an additional 41 hours in real estate specifically, and it has to be tracked. You have to perform more than 750 hours in that real estate service or trade, and you have to be more materially participating in real estate. So material participation means active. So this doesn't necessarily work if you're only passive. You actually have to be more active on the real estate side. Okay, so your first thought might be, oh my gosh, I work already so many hours. How does anybody have time to do this? If you have a will, you have a way. So I know a lot of people who are trying to qualify and do qualify, and they're doctors and they're engineers, they're salespeople. When we first started out, we were working in the evenings and sometimes on the weekend to generate those hours. And it could be you and your significant other that can qualify together. So you can add your hours. Okay.
No, nice.
Yeah. So there's different ways you can look at this, but the benefit is that it can
Did
offset.
we lose you, Jenny?
What's that?
Did we lose you there for a second?
Oh, I'm still here.
Okay.
Okay.
There's
Oh,
a
yeah.
question here is, what kind of records do you have to show as proof?
Yep.
those hours?
Yep, good question. So I use a tracker in Excel. There's apps out there that can help track your hours. Really importantly, the mindset here is you have to assume if you were to get audited, how do I show proof that I work these hours? So whether it's your calendar showing meetings and times and all of that, or it's an Excel spreadsheet that helps you track those hours. You just want to make sure you have something easy to hand over to the IRS if you were to get audited. And there's a whole checklist of what qualifies for hours, what not. Like if you wanted to qualify and you're on the active side, you can count the 1 hour you spent today as part of that too. So there's lots of creative ways to make sure you can generate hours. If you were to travel to go to a conference, if you were to, drive to your rental property, those are all time spent on your assets that would qualify you for active. Okay. For the material participation in that, is that actual ownership of properties? Yes, you have to be working actively on real estate properties that you own. Yep. Okay. Why is this such a huge benefit? If you qualify as REP status and you take advantage of the benefits, it could offset your W-2 federal income. Okay. Federal taxes, not income. So in a nutshell, because of the hours that I work and because I qualify and because of what I invested monetarily in real estate, I was able in my first year offset all of Ronnie's W-2 federal taxes. So we paid 0.
That's awesome.
Okay. So that's a huge benefit, especially if you have high federal taxes or your spouse has high federal taxes. It is an amazing benefit that is currently here to stay unless, knock on wood, something changes in the future. So something you should definitely consider taking advantage of now.
Once you go down that road, talking about taxes is now exciting.
Correct. You can look forward to doing taxes every year. So how do you get started? I get asked this a lot, like, how did you get started in this? So I would say develop relationship through networking. So coming on and going to these types of virtual meetups or even in-person meetups are phenomenal. You'll be able to find other people who are potentially looking to partner up with you if you're looking for partners or want investors, or if whether you're on the passive side or the active side, there's always people looking for deals and people looking for investors. Okay. So just put yourself out there for more of these types of meetups and conferences. There are so many books, webinars, podcasts, and I'm happy.
Facebook groups,
exactly this. So if you put your email in the chat box here, I can send you a list of my favorite curated podcasts and books and websites that I love to listen to stay on top of the marketplace. So yes, share your information in the chat box here or email it to me. I'll share my contact information as well and email it to me. I'm happy to share you my resources. There's just so many out there, but I'll send you my favorites. Find a mentor. So I found one. I latched onto him because I knew I could learn so much, and he was in a state where I wanted to be. He was successful in what I wanted to be successful in terms of real estate. It could be paid, it could be unpaid. Just find somebody or a group that you resonate with and find ways to give them value as well as get value from them in terms of their expertise, and then take action. I know so many people who just have done everything I've suggested. They've learned, they went to conferences, and then 6 months later, they're in the same spot. And it's because of analysis paralysis. Get enough information and just take action, whether it's investing.
One of the wonderful things about the internet is all the information is available at your learn and to study.
Yeah.
Definitely, because it's all there, it's easy to just keep looking and reading and watching and not doing.
Exactly.
Take action.
Exactly. Yeah. So just take action, whether it's invest passively in your first deal just to test it out and see, what you could learn from that. Or if you want to take a jump on the active side, like just do something, take small steps every day so that you can get to your goals faster. Okay. So you don't have to be great to start. You just have to start somewhere. That's super important.
I love that quote.
Yeah, yeah. Some things to consider. Okay, so when I left, some things I wish somebody told me because I didn't think about this. You need to add in expenses. So if both of you guys are quitting, you won't have health insurance anymore. So factor that cost in or plan for it because you'll need to start paying things like health insurance. Taxes. So back to taxes, if you don't qualify yet, you need to find a way to, and you're still getting income from real estate, then you need to make sure you're finding ways to save or have enough to pay federal and state taxes. So I live in the great state of California. State taxes are high, and that's something I didn't necessarily plan correctly the first couple of years. Let's put it that way. So make sure you know what that could look like as you leave and don't have a W-2 job anymore. And then the last two here are just more about, internally self-reflection. So, I worked for P&G for 13 years. It was the only company I knew. And, I was in the P&G cult. I was a proctoid. And when I left, that identifier went away. And there was a time period where I was just like, well, who am I now? So just a little bit of a softer point to think through, like find your new identity and then stay determined to focus on your why. Why did you leave? Is it to spend more time with family? Is it to travel more? Is it to do more charity? Is it to give back? Just make sure you still focus on your why so that you don't lose focus and become unmotivated anymore. Okay, so that's super important.
Yeah, I love that one because I kind of struggle with that too, Jenny. When I left my corporate world,
Yeah,
so many years, I was take that pride of, people ask you, what do you do? I'm a chemical engineer, I'm a project manager, et cetera, et cetera. It actually took conscious effort to say, when people ask that question, say, I'm a real estate investor.
Yeah.
And to have that a quick 10 or 20 second pitch.
Yeah.
Right with that, and change your identity and get into the role and be comfortable with it.
Yep, exactly. Exactly. Okay, well, that is most of my content. The rest I just wanted to share with you. If you guys want to learn more, part of my role in the company these days, I do have a coaching program. I mentioned you guys how important it is to have a mentor. So if you're wanting to learn more about our coaching program where we teach people how to do what we do, let me know, shoot me an email. I'm happy to walk through it with you. Or if you want more information, it's vsvacademy.com here. We also have a conference that we're putting together. I love these conferences because it's a lot of work, but it's also so much fun. It's a labor of love. Our next conference is in Arizona, April 28th through 30th. We bring in industry experts. So I have folks like Ken McElroy, who is Robert Kiyosaki's advisor, if you know Robert, the Purple Bible of Real Estate, the Rich Dad, Poor Dad book. He'll be there, Neil Balwa, other syndicator who are experts in the marketplace. We'll talk taxes. We will always talk taxes at these conferences. You'll learn a lot more tips and tricks. We actually do a bus tour to visit some of our properties in Arizona, so you can actually see how a business plan comes to life. That's one of the favorite parts of the conference. So you can actually look, touch, feel, and ask questions on site. And I'm also bringing, I'm big on mindset. So I'm bringing one of Tony Robbins' speakers to the event as well. We had one last year and they were a big hit. So if you're interested and are able to come into Arizona, I would love to have you guys at the conference. You can register at vsvcon.com. If you want a discount, you can use my name, Jenny, Jenny, as a discount code to get 10% off your tickets.
We appreciate that.
Yeah, absolutely. It's a blast. So if you guys can make it, I'd love to see you and meet you in person. And it's quite a fun time.
Cindy's been trying to force me to get out there,
Yeah. So
good.
that's all I had, everyone. There's my contact information, Jenny@verticalstreetventures.com. I'll put it in the chat box as well. But I'm happy to stick around for as long as there's questions. I'm happy to answer those.
So, Jenny, just one of the, if you're going to cash out, refi, or sell your multifamily unit within your 3 to 5 year window, getting the income up as high as possible is key, right? Is there things outside of just raising rent that you look at for an apartment building?
Yeah.
Um,
Yes, that's a great question. So rent is one of the main source of income. There's other income to include things like pet rent or reserve parking. In Arizona, that's especially hot, literally, because covered parking is a huge benefit if you've ever lived in Arizona. It gets very hot there. Other income, we do renter's insurance as a source of income. And on our more premium properties, we do things like managed internet or tech packages. So there's definitely a handful of other ways you can drive income in addition to managing expenses. Yep. I see a question here from Liza. How did you manage the moratorium on rents during COVID? Okay, great question. So why we invest in Arizona, a couple reasons. And this is great criteria for any market you want to look at. Do we look at population growth, we look at job growth, headquarter growth, where are companies moving to, and very importantly, business and landlord friendly states. Okay, so Arizona, Texas, Florida, those are all great examples of states that hit all of that criteria list. And so in Arizona, for example, during COVID, we didn't have a significant moratorium on rents. In fact, we actually didn't really struggle much on any of our properties. Collections were still very good. Occupancy levels were very good in Arizona. We heard in other states that wasn't the case. And that's again, due to the fact that population keeps growing in Arizona, which means there's a lot of demand and there's not enough supply given the growth there. So that's why we choose states that hit all those criteria for us.
Yeah, I hear from people all the time, especially talking about areas like Phoenix. Market's just saturated with real estate investors. There's nothing, all the good deals are gone. True? False? Sure.
That is somewhat true. So in like everyone hears about Austin, right? Growing.
Right.
And Phoenix is definitely one of those markets that have gotten very hot in the last 5 to 10 years. However, there's still such a shortage of housing. They cannot keep, even with all the new builds coming in, they cannot keep up with the demand. On average, 250 people moved every day to Phoenix, to Arizona in general.
Wow.
Like there's not enough supply to keep up. And then it literally matters down to the submarket. Whether it's Phoenix or the surrounding MSA, it really depends on where you're purchasing. Like for us, we don't buy in downtown Phoenix just because that's a lot of where the new builds and rebuilds are coming out. We purchase on the peripherals of the MSA. So you have to really be aware of the submarket you're purchasing in.
And you did talk about cash out refi versus selling a property. Do you identify that exit strategy when you purchase a property, or is it something that kind of evolves and when you get to that 3 to 5 year window, you look at the numbers again and go, boy, we could keep this asset if we wanted to. Let's change our exit strategy.
Yeah. In our underwriting analysis, our base plan is always to sell. Okay, so on average a 5-year hold time, and then we sell. A refinance, we don't bake in there because that would artificially inflate our returns. We cannot ever assume that a refinance will happen because look, rates right now are crazy.
Yeah.
So if we can do a refinance, that's just going to be gravy on top of our base plan. That's our option too if we need to look at it. If we wanted to hold on to the property, that would be our plan B.
So when you cash out refi, you are paying off all your private lenders, right? All your syndication personnel per the original agreement.
So we return as much of the capital as we can. Let's say we are able to do 100% cash out refinance. Right now, we still keep our investors in the deal. So we don't buy our investors out and keep the property without them. Right now, we still keep them in. And that's the benefit of infinite return. So as long as we hold the property, you just got as much, call it 100% of your capital back, but now you can also still benefit from the cash flow.
But they still hold on part of the equity of the project.
Yep.
Yes. As many of those projects as you can cash out, refi, and hold, the better, right?
Correct.
Yeah.
You got it.
A ratio that you kind of are hoping for, sell 3, keep 1, repeat type?
No, not necessarily. It's just literally depends on the property and the market condition. Yeah.
So what kind of deals are you looking for?
So our criteria these days, we typically look for anything larger than 100 units or 100 doors. We like to have better mixes of 2 bedrooms, higher mixes of 2 bedrooms versus 1 bedrooms or studios. We don't want to buy anything older than 1980s, 1990s, ideally in the 2000s or newer is our range now. And then it just has to be a value add property where there's some meat on the bones to actually go in and renovate. In a good neighborhood with good schools, because we like when families stay at our properties. They typically stay longer, they typically treat it better.
And again, your target is still Arizona.
Yes, right now there's still a lot of opportunity. I know it's hot, it's getting more expensive, but there's still a lot of opportunity. And especially in the next 6 to 12 months, as things start to become more, I should say, transactional. It's kind of slowed down quite a bit in the first half of this year, but I know, I shouldn't say I know because I don't have a crystal ball, but I project in the next 6 to 12 months that things are going to start picking up again. Yep.
Yeah. Discussion within the economy right now. Is it going up? Is it going down? There's always that nobody has a crystal ball. Everybody that says they know what's going to happen.
Yeah.
Them. Yeah.
Yeah. I mean, again, just my 2 cents. It feels like, back in COVID when everything shut down, nobody was transacting, lenders weren't lending. And all of a sudden, mid 2020, Arizona just blew open again and just, you couldn't even blink fast enough and properties were being sold left and right. So I feel like we're on the cusp of that happening potentially in the next 6 months. And so, the time right now is just to learn, build up your database, figure out your goals, your action plan, because if you're ready to buy, it's going to happen in the next 6 months.
Is there a minimum investment that you have to work with?
So for our properties specifically, our minimums typically are 100 grand.
Okay.
For first-time investors, we do offer exceptions as well. So just to try it out, get your feet in, see if it's for you. But yeah, that's typically our minimum.
And you don't need to be an accredited investor.
So great question. There's 2 types of syndications that are very common. One is for accredited only investors, which is one that we typically do. Then for non-accredited investors, there's a different kind. Similar properties, similar returns. The returns don't differ for either one of these. The reason that we do the accredited one is because the SEC allows us to advertise and we can publicly talk about it. For a non-accredited deal or a deal that allows non-accredited investors, we cannot publicize it. But we do offer those every now and then because we partner with deals with some of the students in the coaching program, and they typically prefer the non-accredited route.
And again, that's one of those advantages of being in your inner circle, so to speak, is those deals aren't talked about publicly, but they could be talked about in those private groups. Is that correct?
You got it. Yep.
Perfect.
Great.
Well, appreciate your story. You're quite an inspiration.
Yeah. Oh, thank you. No, I've had a lot of good mentors, and there's a lot of great people in this industry. One of the things I was surprised about was just how many people in this industry are so willing to share their knowledge and help each other. Yes, it is competitive, but it's also very abundant. So all boats rise, the better that we can help each other. And we're impacting lives. We're helping our investors achieve their financial freedom number. And the communities we invest into, I'd like to think we're making them cleaner, safer, nicer, and we get, good positive reviews too from our residents. And we're working on a program right now too that is going to help all of our residents get more financially literate, because
Oh,
they should
excellent.
also benefit from our investment, not just our investors. So that's a big one.
And your very first multifamily deal, what was more difficult, finding the deal or finding the money?
I would say my very first syndication, it was finding the deal. Raising the capital, the very first one, it's your friends and family, it's the people in your inner circle. And they just trusted, given our background, I had with my partners, our background in corporate America, the ability to run the business. That part wasn't as difficult as I thought it was going to be, especially for a very first raise. But just finding the right property took time. Again, it was a unique year just because COVID just threw a wrench in everything. But once we finally found the right one, it was and we still have it today. It's a great property.
Excellent. Is there anything else that our community or myself can do to help you?
Oh, thank you for asking. No, I think, I get inspired and super excited for newer investors just because honestly, we say this all the time. I wish I learned this 15, 20 years ago. I know I look young, but I'm not as young as I look. But yeah, I wish everybody knew this 15, 20 years ago. In fact, I spoke at U of A last year talking to 18, 19-year-olds, and they were just floored and so excited to learn something that could impact them in a way that, what they were learning in class couldn't. So no, I think I'm inspired by you guys just wanting to learn and asking all these questions. It reminds me of the excitement I had when I first started in the industry. So yeah.
Well, we'll share your website. We'll share your email address. We're definitely going to talk about your conference and see if we can't get there. I know Cindy's going to want to figure out how to get me to Arizona. It's coming up very soon. We'll see what we can do. And we look forward to hearing from you.
Yeah, absolutely. Again, feel free to reach out. I love talking about real estate if you can't tell already. If you have any other questions, if there are anything I can help you with, please let me know and just shoot me an email if you guys want more information about anything. Okay.
Thank you very much, Jenny. Greatly appreciate you.
Awesome. Thank you guys so much. Take care. Have a great
Good
rest
night,
of your
everyone.
day. Bye.
Bye-bye.
Thank you, Shane.
Thank you, Jenny.
Yeah, take care. Thank you, Cindy. Bye.